Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Slate grocery stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Slate Grocery REIT is a grocery anchored real estate company. Their largest tenant is Walmart. The company is headquartered in Toronto, Ontario, Canada, and was founded in 2012. All their properties are in the US, but they're headquartered in Canada. It went public in 2014 and trades on the TSX and OTC. They own the entire shopping center, but they only buy shopping centers where there's a grocery store as the anchor tenant. The anchor tenant is the largest and most prominent tenant in a shopping center. It draws in customers as well as potential new tenants. It entered this market after the 2008-09 financial crisis. It saw an opportunity to acquire well-performing real estate at depressed valuations. It has 76 properties and 93% of the stores are occupied. It's in 20 US states and it has 9.6 million square feet of space. So REITs pay out at least 90% of their taxable income as dividends. The benefit of being a REIT is they pay a lot less in taxes than a traditional company. Let's get started with the model. We're going to look at the ticker that trades on the OTC in the United States, since all their financials are in US dollars. They're a small cap company, 482 million market cap. They're trading at $10 a share and they have 47 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have positive and consistent free cash flow each year. The easiest way to value a company is when they have positive and consistent numbers. The numbers don't have to be really good, they can be weak or they can be strong. As long as they're positive and consistent, then it's so much easier to value them. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2018, positive after that. Revenue is the sales for the company, and that was the highest in 2018 at 144 million. It did drop in 2020 to 126 million. This is due to COVID and losing some tenants or giving discounted rent to other tenants. This is the company's income statement. The top line is the revenue, the sales. These are the rent payments it receives from its tenants. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Example are the taxes on the property, insurance, the maintenance. Revenue minus cost of revenue gives you your gross profit, and that was the highest in 2018 at 104 million, dropping to 93 million in the trailing 12 months. That's mainly due to lower revenue. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income, which peaked in 2018 at 95 million. It's down to 87 million, but it is up from 2020 of 83 million. Below that is the interest they pay in their debt, and they paid 21 million of interest in the trailing 12 months, which is lower than 2018 of 37 million. Below that is other income and expenses. This positive $72 million is the gain from the sale of an asset. That's why their net income is so strong in the trailing 12 months, 103 million, due to the 72 million of other income and expenses. I would focus on operating income when I look at the income statement. That's a better indicator of the company's core operations. Net income can be really volatile because the income statement uses accrual accounting. I'll show you what I mean on the statement of cash flows. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. There's a lot of non-cash items and a lot of things that can really skew the net income number. Cash flow, as you can see, is a lot smoother and more consistent. And operating cash flow is a much better indicator of how the company's doing than net income. You can see that operating cash flow in the trailing 12 months was actually higher than 2019. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx give you your free cash flow. Most of the company's free cash flow is used to pay dividends. You can see the company has been paying down debt each year. In 2018, they added 38 million of debt, paid down 59 million. So they reduced their debt load 20 million in 2018. They also reduced it 80 million in 2019 and 23 million in 2020. They did increase their debt load 30 million in the trailing 12 months. This company pays a generous monthly dividend, but another way to reward shareholders is to buy back stock. They bought back 21 million in 2018, then 22 million in 2019. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. But in 2020, when COVID hit, they probably got concerned they were going to need more cash to run their business, so they issued 56 million of capital stock. When a company issues capital stock, that increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. $500 million of equity, $800 million of debt. They're 40% equity, 60% debt. And their WACC is 8.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 900 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $800 million. We divide that by 47 million shares. And we get a calculated stock price of $17. They're trading at $10, so they're trading at a 39% discount. It's a strong buy according to the model. Simply Wall Street is a little higher than me. They're at $18 a share. They're also saying the stock is undervalued. This is the stock price since it started trading, so it looks like it was pretty flat for a few years. Then it took a major crash last March. It looks like it was below $4 a share. This would have been a great time to pick up the stock because the stock price climbed all the way back up, just about at its pre-March highs. This is the stock price the last 12 months. So it looks like it was fairly steady. It did drop a little, then it came back up. And it looks like when they paid out their dividend, the stock really dropped, but it came right back up the following day. That is kind of weird. And it looks like it's been climbing a little bit since then. They pay a really good dividend, 8.5%. To calculate the dividend, you could just multiply the last dividend payment by 12, take that number, and divide by the stock price. They pay out 40% of their net income and 97% of their free cash flow. Their industry pays a 3% dividend. They're well above that. If you hold a regular stock for over 60 days, then you pay long-term capital gains on the dividend payments, which is 0% to 20% depending on your income. All dividends on REITs are taxed as short-term capital gains, 10% to 37% depending on your income. It's something to consider. If you were getting a 4% dividend on a REIT and a 3.5% dividend on a regular stock, you're probably better off at the 3.5% dividend because of how much you get taxed on a REIT. Their biggest tenant is Walmart, then Kroger, then Publix. 38% of their rent payments are from supermarkets since those are the anchor stores in their shopping centers. They own the entire shopping center, so there might be 5, 6, 7 other smaller stores. And they have 13% restaurants, 5% fitness, 13% medical, and a whole bunch of other things. They have 11 shopping centers in Florida and North Carolina. Most shopping centers are 90% occupied or more. The only one that is struggling is the one in Kentucky, only 62% occupied. So more than 1/3 of the stores are empty. They have a beta of 1.63, so the stock is more volatile than the market. It moves about 1.5 times the market. The stock has gone up 21% in the past 52 weeks, while the S&P 500 went up 31%. But you do get that 8.5% dividend payment, so it's not that far off the S&P. The 52-week low was $6, the high was $11. The stock is trading above its 50-day and 200-day moving average. Only a few thousand shares are traded each day on this stock. Of the 47 million shares outstanding, almost all of them are on float. 22% of the shares are held by institutions. Examples are mutual funds, pension funds, insurance companies. If you include dividends in the past year, this stock has gone up 32%. It's better than its industry, but worse than the market. In the past 3 years, they underperformed their industry and the market. Also in the past 5 years, they underperformed their industry and the market. In the past 5 years, their annual earnings increased 46%, its industry 10%, and the market 12%. In the past year, their earnings grew 216%. That's mainly due to the $70 million gain in other income and expenses. Their industry decreased 11% and the market increased 21%. The biggest shareholder is EdgePoint. That's a Canadian mutual fund, 8.3%. And this company owns 7% of their stock. Then Leith Wheeler, Northwest and Ethical, and last is Dimensional Fund. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a really good PE at 4.7, so investors are paying $4.70 for $1 of earnings. That's much better than the market median and average. Price to sales is 3.8, which is between the market median and average. And they have a really good price to book of 1.0, so they have a really good balance sheet. Their return on invested capital is 5.2%. I like to see an ROIC above the WACC. They're below their WACC. They can cover their interest payments over 4 times. They have a really high ROE at 20%, much higher than the market median and average. And they can cover 90% of their current liabilities with their current assets. And their current assets are mainly restricted cash of $106 million. This is cash that's set aside for a specific purpose. So the company does seem to be undercapitalized. They did have $42 million of free cash flow, negative $15 million of working capital. Working capital is current assets minus current liabilities. And they have $41 million of dividend payments, so they're short $14 million. So they may need to take on some debt over the next 12 months to fund their business. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 13 companies in the same industry as Slate, and if Slate has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. A good ratio to look at when valuing a REIT is the price of the stock over funds from operations per share. Funds from operations is net income plus depreciation and amortization minus the gain on the sale of real estate. The lower the better for this ratio. They're at 12.0. The average in the industry is 16.8, so that looks really good. Also, their price multiples are really good compared to the average in the industry. Their current ratio is below average. They have a good ROE. Their debt is pretty close to average. And they're a really small company, $500 million market cap. The average is over $5 billion. And they pay a massive dividend, 8.5%. That's the highest on this list. So to summarize, I have them trading at a 39% discount. This company is doing a really good job at growing their business. They're putting up consistent and positive numbers. And in 2020, they still were profitable. They had positive free cash flow, and their revenue didn't go down too much. So I think 2021 will be their best year. Plus you get that really nice 8.5% dividend. So even if the stock price is flat for the year, you're still getting an 8.5% return. Plus you're getting a monthly dividend. I know some people really like that monthly dividend. I ranked their free cash flow 6 out of 10, their revenue 6 out of 10, and their ratio is 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.